It's October, which means we're 10 months into the Tax Cuts and Jobs Act, the new-ish law.
I don't know. You said that with such enthusiasm. I was
Tax Cuts and Jobs Act. Yeah. Anyways, the newest tax law that was passed at the end of 2017. Hopefully, you're among the majority of Americans who have indeed seen a lower tax bill, likely around a few $100s to maybe a couple $1,000 if you're a typical American household. Unfortunately, there are households that will end up having to pay more tax due to a loss of some deductions, which we'll talk about in a little bit. But regardless of your situation, there may be some steps you can still take to reduce this year's tax bill before 2019 rolls around. And here to help us discuss these strategies is our resident tax expert, Megan Brinsfield of Motley Fool Wealth Management.
A sister company of the Motley Fool.
Yeah, there you go. But so I thought before we talk about the tax tips, maybe we should just hit, as a reminder, some of the highlights of the new tax law. So first of all, there's still 7 tax brackets, but lower overall rates except for the bottom 2, and it takes more income to move up to a higher tax bracket. So in that sense, most people probably will be paying less taxes. Big thing is higher standard deduction, right? $12,000 for singles, $24,000 for married folks, which will probably drop the percentage of people who itemize from 1/3 in 2017 down to maybe just like 10% this year. The vast majority will not itemize.
Yeah, I think itemizing was already kind of something that few people did, and now even fewer will do it.
Right. There's elimination of many assorted deductions, too many to list, but some of the more common ones were unreimbursed employee expenses, tax prep expenses, sorry, Megan, and all your CPA colleagues, moving expenses. So a lot of those things have just gone away. Also, the elimination of exemptions, but the expanded child tax credit, which is good. And perhaps one of the more controversial was the limitation on the SALT deduction, the state and local taxes deduction. So now the total amount that you can deduct is $10,000 per year. And this is probably one of the bigger reasons why some people actually will be paying higher taxes this year than last year.
Yeah, exactly. And you hear a lot of cries from higher tax states, people living in places like California or New York, where they're paying 10% annually in taxes, and they have to, in general, earn a lot to live in those places. And so they would have had a much higher deduction under the old plan. I actually just did my taxes last night. I'm an extender, and I was looking at how much benefit that provided me, and I'm by far not earning anywhere near what a lot of people in California and New York are. And so I can definitely feel that pain. The good news is that on the flip side, a lot of people who are itemizing are families that have kids and will benefit from a much higher child tax credit than has been seen in the past. The expansion of that was very large. So now if you're a married couple, you can have up to $400,000 of income before your child tax credit starts getting phased out. And it used to be something like $110,000. Right. So that's a huge band of people that credit is now open to.
So just to be clear, when the law was passed at the end of last year, a lot of states tried to get around this limitation on the SALT deduction, but in the end, none of those are going to work, right?
Right. The IRS said sort of squashed those workarounds with proposed regulations that they issued over the summer. And the workaround was the state would create this charitable entity, and people could make charitable contributions, which are still deductible to an almost unlimited extent. And the state would then give you an offsetting credit for your charitable contributions to that fund. And the IRS said, no, that doesn't pass the smell test. You're getting services back equal to the amount that you're paying, which I'm sure someone somewhere could argue against. But it sort of put an end to those potential workarounds that were alive and brewing for about 6 months.
Gotcha. There were a lot about the new law had to do with corporate tax rates as well. We're not going to get into those. We're going to talk mostly about individual tax rates. That said, for those who are business owners, one big change was the 20% pass-through deduction. what exactly was that and is that? And I know there was some confusion about it, and there was only relatively recent some clarification about who can take that and who can't.
Right. So the biggest thing is it defines pass-through entities a bit more broadly than it has in the past among tax professionals. So it used to be things like LLCs, S corporations, and partnerships were pass-through entities. Now under this law, you're actually adding in sole proprietorships, which are people who basically never bothered to set up a business entity, and allows them to deduct 20% of their net income, assuming they don't make too much. So this is a place where what is earned inside the business actually coordinates with everything else you earn on your return. And if you're mad at your spouse for messing up your taxes, they can do it particularly well in this area as well, because you're looking not only at business income, but if your total income exceeds a threshold, I think it's $157,000 if you are single and $315,000 if you're married. So if you have a high earning spouse, that can kick you out of being qualified to take this deduction on your business.
I seem to recall reading that after this was passed, there was some people who were thinking, like, I'm an employee now, but I love the idea of this 20% deduction on everything I earn. Maybe I'll just become an independent contractor and take this. But that also has been somewhat squashed, right?
I don't think it's been as formally squashed as it has been just impractical. A lot of people, like being an employee or a contractor, comes with different assumptions around the work that you're doing and who has control over your time and who's responsible for a lot of expenses. So if you say, yeah, I want to be a contractor, suddenly you're signing up to take care of your own healthcare and computer and work expenses that might have been covered by your employer in the past. And that's not necessarily going to equal out with this deduction going forward. The other thing is that the law says if you have a business that is solely relying on your skills, you can't really separate yourself from the business entity, then you're even further limited in taking this 20% deduction.